adding to losing trades. You've been told your whole trading career adding to losing trades is horrible. Losers, average losers, you should only add to your winning trades. You should have a good risk-reward ratio, risk 1% of your account per trade. I'm here to tell you that sometimes adding to a losing trade is actually the best thing you can do. And you can tell I'm serious about this because I'm yelling a little bit and I'm holding a firearm. If this is your first time to my channel, welcome. My name is Nick. I'm just some bald guy who trades. In this video, the whole purpose of what I'm trying to do is to encourage you to go out and try what I'm about to teach you here in this video. I'm not going to hold anything back. I'm going to show you literally what I actually do every single day. And if you would literally want to follow what I do every single day live for free, join my free Telegram channels. First link in the description of this video. I'll put it in the pinned comment too. You can just follow all my daily analysis and trades. Every single thing that I do, I put it all right here in this Telegram channel. I've made $30,000 doing exactly what I'm about to teach you here in this video the past month. I show the full trading history, the full P&L, the trades that I'm in right now. I'm going to show you 3 trades that I've actually taken that I've used this trading approach on. And then I'm going to show you 1 trade that I'm in right now where I've used this exact same trading approach. And I'm going to prove to you that sometimes adding to losing trades is literally the best thing that you can do. So let's go ahead and get into it. Let's just frame it in here for a second. So first things first, trading's risky and most people lose money. You're probably going to lose money trading even if you listen to every single thing I say. It's hard. I'm not trying to veer away from that fact about reality. However, I've been trading for 8.5 years. 6 of those years I've been profitable. And using this exact trading approach, I've been doing this for the past 2 years, more or less, like little hybrids of it. But right now, what I'm about to teach you is the simplest way to do this and why adding to losing trades is actually the best thing you can do. So it's born of 2 things. You have to understand 2 things. In markets like the Forex market, price does not go one direction forever. Price has reversions, meaning it goes up and then it goes down, then it goes up and then it goes down. Go look at any Forex chart. Price does not just go bull candle after bull candle after bull candle after bull candle forever. So by simply adding to a losing trade, it allows you to be wrong a couple times in a row, but still be right about the move and end most outcomes in either a break-even scenario or a profitable scenario. A small percentage of the time, you're going to have a big loss. It's going to blow the account. Some people hear that and they just run away screaming, kicking and crying, trying to learn smart money concepts. They want to instead trade. They would rather trade the order block accumulation, liquidity flow, bank manipulation, stop hunt, volatility spike, Kobe steak, Wagyu beef bullish, institutional order gap, candlestick trading strategy. Instead of just listening to me who's saying, hey, make sure you have enough in the account and then use small position sizing. Enter where you think it's going to bounce at. And if it keeps going against you, wait till it gets to the next area you think it'll bounce, add to it. If it keeps going against you, do the same thing over and over again. And most of the time, meaning we're talking like in the 90 percentile, right? Like 99%. I don't know the exact stat, but most of the time, price has a little bit of a reversion and you can get out of most trades in either a profit or a break even on the basket of entries you've had. Now, again, you have to do this in a specific way that makes sense. You can't just start using one standard lot on a $1,000 account and then hope and pray that your first entry goes into profit. It doesn't work very well that way. However, if you size the position size way smaller, my non-financial advice, generalized suggestion for information purposes only, is to use about 0.01 lots for every $2,000 in the trading account. So if you have a 4K account, you can use a 0.02 lot for your first, no, that's right. 0.02 standard lots for your first entry. If you have a $5,000 account, you want to be safe, just use 0.02. If you want to be, a little bit on the riskier side, use 0.03 standard lots. If you do this, yes, your profits are not going to be crazy. You're not going to be rolling in the dough for the first year or two. You're not going to be making millions of dollars every single month trading. That's fine because at least you're not blowing your account and losing money because 90% of people lose money. If you can just even break even, that's doing better than 90% of people. If you can make a profit, you're in the small single-digit percentile of people who are actually making money trading. And what I'm telling you right here is not really rocket science. It's actually common sense. But common sense is not typically common practice, so I have to make this whole YouTube video about it to show you. We're going to go look at some charts right now. I'm going to show you some trades that I've taken, and I've actually called all these trades live. And if you just want to go see the results of this, you can literally go to my Telegram channel that I told you about at the beginning of this video. Scroll back in the history. You can see when I took all these trades. You can see me share the results of them. You can see me. I show my trading account terminal P&L. I literally just show everything, and I teach it all for free here on my YouTube channel. And then I show the analysis live every day in my Telegram channel, and that's it. So it's just like I do like 90% of this for free. I don't even monetize my YouTube channel that you're watching. You didn't see an ad at the beginning of this video. I don't even monetize my channel. The only way I make money is if people want to follow my exact trades. Then I have a little monthly subscription. That's all I sell. But you don't even need to do any of that. You could just watch this video and you're going to learn everything. So let's go ahead and get into it here. I'm going to show you 3 trades I've taken in which I've added to them and how it all worked. And I'm going to show you everything. So I'm trading on an account right now. It was at $165,000 about a month and a half ago. And again, you can see all this in Telegram. You can see my account balances and terminal and everything. And now the account sits at $196,000 in closed P&L or in the balance, and then 190 in equity because I'm in these trades right now, which we're going to talk about here in this video. So here was one of the trades that I've taken over the course of the past month, the past rolling 30 days. I bought right here. Now, some people would say, oh, it's a horrible place to buy. You're buying at a resistance zone. I'm not here to debate that. I don't care what your reasons for taking trades are. The reason you take a trade is just your story that you tell yourself as to why you think price is going up or down. It's just a narrative you put behind it. Your reasons for a trade really don't matter. All that really matters is, do you buy or do you sell, and how do you control the risk? And that is it. Your experience and intuition is what will dictate whether or not you're profitable, not the reasons for your trades. I know that may sound ridiculous. Anybody who's profitable trading long-term using a manual trading approach is using their intuition, their instinct, their experience, their discretion, their discernment of price action. It is not some black and white strategy, because those don't work if you haven't already noticed that yourself. So I bought right here at these highs and price went against me. So what did I do? I bought here again as price went down. And then I bought here again. Well, I can't remember if I actually bought here or not at this low. I think it barely missed the alert. But what did happen is that price did turn back around and head back up to the upside. And I was able to close these right here in almost a break even among the basket of trades just from adding to the losing trade. And so this one worked out really, really well. Again, you can go see this for yourself in the Telegram channel. And if you had been using a stop loss, a lot of people will say, just put your stop below one of the recent lows or just below the breakout point. This trade would have probably been a stop out right there. And then if I would have added again here and started a new trade, like a buy down here, and put in a stop loss below this recent low, some people will call this a support resistance zone. You put a stop loss just under that, might have been stopped out as well, and then I would have lost that trade. And then if I would have bought again, this one would have worked out, that one would have bounced. Would you have made back everything you lost in the first two? It just depends on your position sizing and risk management and risk structure and risk reward and all this other stuff that just doesn't really matter long term if you have experience and intuition. So price did go back up and everything was fine. Everything worked out. So a lot of you are thinking well, what would have happened if it would have just kept going against you? Well, here's what I would have done. I would have just continued to add. There was multiple zones to add at, meaning multiple locations price would bounce at. So that was the zone right there. This was another one right here. You see the alert for it is still actually right there at that same spot. I would have added right there, would have added right there. And then as long as it bounces anywhere, meaning if it would have gone all the way down here, as long as it bounces somewhere, let's say it bounced right there, for example, after I was wrong 5 times in a row. When it finally bounces, I can close everything at a net break even. Now, how does this work? Because you have to have small enough position sizes, otherwise this won't work. If you just use 0.01 standard lots, this is a micro lot. This is the smallest position size you can use. For every $2,000 in the account, in general, this works fine because you can get most of the time out of trades in either a profit or a break even. And that is what allows you to profit even when you're wrong. And oftentimes the best decision is just to add to the losing trade. Obviously, the next area you think it's going to bounce at, there's nuance here, there's context, you have to have a little bit of experience. But what I'm saying is, in general, adding is generally the best thing you can do. Because when you look at these charts, you'll notice that even if there's a slight tilt upwards, like you see it's a tilt upwards right here, price does not go straight up and down. Price has these swings where it goes up and then it pulls back, and then it goes up, then it has all these little pullbacks in here. Then it goes way up and then it has a big pullback, but then it pulls back that way, but then it goes down here, but then it goes back up here, it goes back and forth. As long as your sizing small enough, you can profit almost every single time or break even almost every single time on an outcome, even if you're wrong, and especially when you're wrong multiple times in a row. So this was one of the trades. Now let's go to EURAUD. EURAUD was another one. So I started the original trade, and if you want to see these exact specifics, you go to my Telegram channel. The actual literal entry prices and everything on the orders and the terminal P&L, everything, it's all there. You can literally see it all there. So it's in my Telegram channel. So I bought right here. and then price went down, and then I cannot remember if I added again here, but I do know that I added again around these lows, and then price popped back up, and this ended in a net profit. And this net profit actually helped cancel out the loss from GBPNZD, because I was wrong about this too. So these ones resulted, like, this was then like a couple $100 profit. It canceled the loss for GBPNZD, which was a couple $100 loss. And then it ended up going up and everything was fine. It ended up working out. But instead of these two being losses, GN and EA, these were just like net break evens. So it worked out really nice on both of them. And I was wrong. And I still got out at break even. So it didn't really cost anything to my account. So GBPUSD is a trade where I started a position up here. It continued to go against me, and I added. And then when it finally turned back around and came back, I closed when it had this huge spike down. And I didn't close in profit. It hit my profit target because I had a profit target set. So it spiked down, it hit my profit target, and this ended up working out amazingly. Now, one thing that you'll notice is whenever you're adding to losing trades is if you literally just flip a coin, and then if it's heads you buy and if it's tails you sell, you'll notice half the time you're going to be right instantly. And the other half the time, you're going to be wrong instantly. So one could say that given enough trades, you're going to have about a 50% chance of just being right randomly. And again, this is without you having to play all these mental gymnastics and saying like, yeah, bro, it's at a trend line and it's uptrend, so it's going to go up, and it's had a pullback to the 51% Fibonacci level, or what is it, the 61.8 Fibonacci. And then there's also a support resistance zone there. And then I checked the fundamental news calendar, and the dollar is really strong, so it's going to go up. And you have all these reasons. If you don't have experience to then also be executed in tandem with those, quote, reasons you have, they don't really matter because you don't really know what the hell you're doing and you're not profitable. And if you were profitable, then you would be saying the same thing I'm saying, which is like, yeah, I'm profitable and sure, I may have a quote strategy, but ultimately I still have to kind of like use some sort of parsing mechanism in my brain to decide which trades are good and which trades are not. And really, you don't really need any more reason than just looking at the chart and asking yourself, do I think it's going to go up or down? And then if you don't know, you just flip a coin. And this is just starting off, just to get experience. Just flip a coin. Buy if it's heads, sell if it's tails. A lot of people think this is ridiculous, but what I'm saying is the point of this video is to get you to go out and experiment to do this for yourself. I'm just teaching you all of this. I don't care how ridiculous you think it sounds, because you're probably thinking to yourself like, this is a little bit ridiculous, but I don't know, but some of the stuff he's saying kind of makes sense, but I don't really know. It is what it is, right? I'm just telling you, go out and test it for yourself. You can validate these things independently on your own by just going out and doing it, as long as it's sort of roughly in the way that I'm describing it. So if you just flip a coin, you buy when it's heads and you sell when it's tails, and then you use this DCA risk structure, which is just dollar cost averaging, adding to losing trades. It's just a fancy way of saying that. Then you can get out of most outcomes and profit. Let's look at another one. So GBPCAD was another one where I made a lot of money on. Price went up and made a higher high. I started a position. Actually, there was 3 of them. So I started a position here, added up here. Then when it spiked up here, I added again. So this was 3 positions. When it had a huge move down here, I say huge, I mean, it was, it had the nice move I was looking for. It hit my profit target. I got out of this in profit. I ended GBPCAD and GBPUSD, both of these outcomes, because they played out at the same time. I took them at the same time. These ended in like about a $5,000 profit or something close to that. I mean, like 4,000 or 6,000 or something around there. Again, you can just confirm all of this and see all the details in my Telegram channel, because I'm trying to work off just my memory here. I don't like editing these videos. I just like being raw and candid and real and just speaking off the hook, and just, some people would call this winging it, but I don't know. I actually enjoy it whenever I do it this way, because I can really get engaging and feel like I'm actually delivering you the raw, candid value instead of like having to cut and do like 3 different takes and stuff like that. I'm just saying this all, but you can confirm this in the Telegram channel. You just go there. You can see for yourself. So with this being the case, these are all adding to losing trades, and they still ended up working out. So what about whenever you get into some trades that are really struggling to work out? Because that's what I'm in right now. So what am I doing right now? I will show you. Now, I'm in a trade here on USDCAD. I don't even have to draw the stupid little yellow lines here. I can just go to my Telegram channel and show you what it looks like right now. These are the positions I'm in. And I'm actually in more since I started this. Here is my subscription group. This is the one. It costs $250 per month. You follow my trades in here. I share my exact trades, but you'll see here. I'll show you. So right here, you can see that this is right here. All my positions. I'm in 5 lots up here on the current market price, and I've actually sold earlier down here. And you can also see the other trades that I was in. So on USDCAD, I've sold right here at this resistance zone, and then I added again as price went up. We're going to use the little arrow things, and then I've added again up here, final position. So in total, I'm in 10 standard lots. And this is what it currently looks like. So the more price goes in one direction, the more likely it is to pull back. If we look at USDCAD, for example, I mean, this is since like 2022, right? This is the past few years. That was a huge move there. 900 pips, then there was a pullback. And this pullback was 340 pips. But a move up, a move down. We had this huge move down right here, 500 pips, followed by a pullback. That pullback upwards was like 400 pips. It pulled back 100%. This went up here, and then it went down, and then it went up one, and then it went down. And every single time you're seeing like just this much on the chart, you're right. You've sold, you've sold, you've sold, you've sold, you've sold. You're getting kind of scared. You're like, it's going up. What if it just goes to the moon and then never comes back and this and that? And then it has its nice pullback. And then it goes up again, and then you sell again, and then it has its pullback. And then it pulled back all the way here, and then now it went back up, and then now it's tugged back around. And here we currently sit with USDCAD having gone up over the course of the past 2 weeks, about 400 pips. So juicy for sells. I'm getting so excited right now. I am so excited about this USD. I'm going to save that for after the video. If you guys saw how I actually traded, you would lose your mind. I threatened the charts with my AR-15s and with all my Glock handguns to make sure that the market does exactly what I said. That's actually my trading strategy, how I win. But I can't talk about that because then the banks will come to try to get me. The market makers are going to come. They're going to put a bag over my head. They're going to tie my hands behind my back and drag me and force me to trade for them the rest of my life. So if you guys don't see any YouTube videos from me for the next week or two, you know what happened. Anyway, so I'm in this trade right here. And then what's going to happen? So let's say it comes back here and it goes into profit and comes down here. If price comes down here to this zone where it broke past where I thought it would bounce at initially, I would close there, or maybe a little bit before it, maybe a little bit higher. I'm going to drag the alert up here just to be safe. Probably going to close up there. So I would close because it could be likely to bounce at that zone. And if price is likely to bounce at that zone, I don't want to keep staying in my sells, especially when I'm in like, a big position relatively, it's 10 standard lot sells on the USDCAD. I don't know. So I'm going to be closing it right there. How much profit would that be? Maybe they're like $5,000, 5,000, 6,000, 4,000, something like that. It's just going to be a couple $1,000s if it works out. Now, the current draw that I'm sitting in, you can see it's about $6,000. $5,500, $6,000, something like that. That's the current drawdown. And if it goes against me up here to the next area I'm going to add, that'll be like maybe $8,000 of drawdown. If it goes up here to these extreme highs in the weekly, like we go to the weekly chart, you can see if it can bless us with beautiful prices up there around like 139 or 1.395, I could add again right there. That would be so sexy, so amazing. But that would be like maybe $15,000 of drawdown. And I could add there. Again, this is no big deal. And why? Because you can't even see the terminal. There's too many trades. You could see the equity there is 190. Here's the terminal. So 190, there's almost $200,000 in the account. For me, a 15K drawdown on a 200K account, knowing that the statistical likelihood of the trading opportunity playing out long-term is high, that's no big deal for me. Plus, I've made like $31,000 pre-commission, maybe like $30,000 over the past month and a half, just doing this exact same thing. The max drawdown during this whole time period was $6,000. And it happened like today, like this morning. The peak drawdown was like $6,000, $6,500. And that's the maximum drawdown I've had. The whole past, we're getting to 2 months. So maybe like a month and a half. Only 6K drawdown max, but a $30,000 closed P&L. So I have more than enough profits to offset. Even if I get a $30,000 drawdown, that happens once in a while. If I know the likelihood of it eventually having a reversion and pulling back is extremely high, like in the high 90%, then that means that there's nothing to worry about. So in this case, what I'm proposing right here is that one of the best things you can do right now is be adding to USDCAD if you're in sells and you're in a loss, and just continue to do it as long as you're using small sizing. I'm using extremely small position sizing for the type of balance and the leverage that I'm using, so it's not that big of a deal for me. Another one is NZDUSD that I'm in right now. And I've started a position up here. I bought up there. Price went down. I bought again. and price started to go up, I think my initial position was like up here. You know what? Let's just stop playing these games. I have it right here. I think it was in Telegram. Here we go. So this is what it looked like. It was like maybe like this morning or whatever. So I bought up there. I bought again down here. You can see that price is like halfway in between the entries. Now it's starting to kind of tug back. What I'm waiting is for 619 to hit. So 0.62 essentially. Then if price goes all the way up there, I'll make a big profit. Now, what am I going to do if that doesn't happen? Well, you can see I already have an alert down here. If price goes down here, I will add there. I'll be in a couple $1,000s drawdown, and that's fine. And then if it bounces there, right, maybe I'll close everything in a net break even here. So I was wrong a bunch of times in a row, but I avoided a losing streak. Otherwise, you know, let's say you get in a position you're wrong, another one you're wrong, another one you're wrong. Now you have a 3-trade losing streak. You'd be very lucky if like your 4th trade that you happen to win at all to begin with, and if you win enough to just break even on the last 3 trades, and then on top of that to break even on them and then make a profit. It just gets so difficult to like use stop losses in that way. Now, I used to use stop losses and I've used them for years and they work fine, right? You just have to use them in the right context. But whenever you're taking losing streaks like that, it's really damaging to your psychology and to your confidence. And it makes you feel like crap. And your romantic partner tells you that you have to sleep on the couch because, you know, for example, your girlfriend's boyfriend is telling you that you're only allowed to use the Wi-Fi once to watch one Nick Sean video every single day. God forbid if the Nick Sean video is more than an hour long. I don't want you to have to be in that position where your partner's girlfriend or boyfriend is telling you that you can only sleep on the couch and use the internet once a day to watch these videos. I want you to watch multiple of these videos so that you can get help. And I'm trying to prevent that from happening, which is why I'm teaching you good risk management here, even though, you know, I'm literally telling you to add to losing trades. But again, you're doing it in this context that works. So if price goes up, if price goes down here and I add, then it pops up, then I'll make a break even. If it goes all the way down here to 0.59, I've allocated enough margin to that, and that could happen, right? It doesn't. If it does happen, it doesn't matter. As long as it bounces somewhere, then, you know, it'll bounce up. It would take a lot to blow this account, but if this account blows, it's okay, because here's the thing that everyone says: oh, it'll never work. You're gonna blow your account. I'm done. They don't even listen to anything else I say next, because they don't want to actually examine things and be curious and see what the reality is. Here's what it is: if you are trading with $2,000 in an account, just make sure that your total trading capital is higher than that and that you're comfortable risking that amount and risking that account to blow it. Your account functions as a stop loss. I do not recommend, if you have $10,000 to trade, putting all the $10,000 in an account and trying to do this. Just because I'm not an idiot. I know at some point that account's going to blow and you could blow it on your first try, especially if you have no clue what you're doing. I don't want that to happen to you. You should be using a demo account when you're starting in any ways. But let's say you have 10K to trade with and you're comfortable risking $2,000 of that 10K, right? This is 20% of your trading capital. If you have a lot more trading capital, perhaps you're only comfortable risking a little bit less than that. It's all up to you. You get to define it. But you put $2,000 into account, you trade with a 0.01 lot size. You know you're going to win, meaning you come out profitable or break even. You know you're going to win almost every single outcome. Every now and then you're going to take a big loss, and then every now and then you're going to blow the account. If you know that those things are true, every time you double the account, you withdraw. And then you do it again, you double the account, you withdraw. And you double the account, you withdraw. Let's say you do three times the 2K account. You made $2,000, so $6,000 profit. Then the 4th time, you blow the account, right? So you blow the $2,000 balance that was in the account. So you've made $6,000 minus the $2,000 that you lost. You're still in a 4K profit. That's $4,000. And this takes almost no work, because if you're using daily and weekly charts, you only really need to check the charts once a day. And that's not an embellishment. That's not me like being like, yeah, you only have to trade 10 minutes a day, bro. Like, think it through. If you're looking at daily and weekly charts and they don't really change that much, then you've already figured out the risk structure. You're like, I'm going to enter here. I'm going to DCA here. DCA means dollar cost averaging. Look it up. It just means adding to losing trades. I know I already said it. You'd be surprised how many comments I still get of people asking me what that means. You add here, you add here, you add here. Then when it finally reverts, you just close it all. You adjust your profit target somewhere you want to close it at. And the more experience you get doing this, the more things kind of start to flow. Kind of starts to flow like the Nile River back in the ancient Egyptian kingdoms, you know, and the pharaohs are seeing the Nile flow and they're all getting their lime from the river and they're using it to make that ancient Egyptian concrete to build the pyramids. You can build a pyramid by using this trading strategy. I'm just kidding. You can't do that. That would take a lot of work, and we can't even do that today. But what you can do is you can know that you're probably going to grow an account more than 50% of the time, and not blow an account more than 50% of the time. If like 75% of the time, right, 3 out of 4 times you can grow an account to the growth target of doubling it, and then 1 out of every 4 times you're going to blow the account, well, that's still a profitable trading approach. You get 3 accounts doubled, but then you blow 1 of them, and they're all the same starting balance. It's not that big of a deal. When you're doing this, a lot of people will call this Martingale. I guess you could say it's like a pseudo Martingale approach, but not really, in the sense that you're not really doubling your bet. If you look at me here, for example, on NZDUSD, my first position was 1.5 standard lots. It's kind of hard to see. There's 2 positions here. You can only see the 0.05, but you can see the 1 underneath it. It's 1.5. Then I added 1.5. And if it goes against me down here, I'm going to add another 1.5. I don't increase the lot sizing unless price goes significantly far against me. Then I'll start gently increasing the position size. Instead of 1.5, I might start using like 2 standard lots. And then if that doesn't work and it keeps going, then I'll start using 2.5 standard lots. And some people will say, oh, this is just Martingale. Martingale is like if you start with 1 lot and then it goes against you, then you do 2 lots, then it goes against you, then you do 4 lots, and then 8 lots and 16 lots. That gets out of hand really quick. And in my experience, it doesn't really work that well unless you happen to get a crazy win streak with no drawdown. Then you get to the growth target really quickly, but that almost never happens, and I do not recommend doing that because the likelihood of blowing an account is extremely high, much higher than just using a 0.01 standard lot for every 2K in an account. For God's sakes, use a demo account for the first few months, like 6 months to a year, just to get experience. You have no real capital on the line. Only thing on the line is just your time experimenting with this and testing it, kind of getting the experience to say, well, if I wait for price to get there, then I sell. Maybe 60% of the time that wins, right? And the only 40% of the time you even have to use the DCA risk structure is if it goes against you even further. And if you're already waiting for price to go really far in one direction before you enter, it's like going skeet shooting with the boys. You know, you're going, they're shooting the little things up into the air. You're having to like point and like do this stuff, and then you're shooting it and you blow up the little clay things or whatever it's called. I don't do that. But if you do that, that's cool. And you can do that figuratively here on the charts in TradingView. So whenever we're here on the charts, you can see that my positions here, oh, this isn't even my current positions here in Discord. Yeah, it's in the Nick's Trades group. All right, my current positions here, you can see I've added all these. I have not really increased the position sizing. This was 2 entries of 1 standard lot. This was 3 entries of 1 standard lot. So 2 lots here, 3 lots here. And now you can see it's 5 lots up here. This actual specific one, the position size is actually slightly increased, but the way I ran this risk structure was I waited a long time to add the upper positions here. What this should have been is it should have been 3 lots down here, but I only went 2 because I thought it could break. And then it should have been another 3 lots here, and then another 3 lots here, and then another 3 lots here. Instead, what I've done is I've kind of broken it up to where I started the position really small because I thought there could be a breakout, but it was still good enough to like just sell right here anyway. And then I've added the small positions here. I didn't even add at the area I was planning on adding first. I actually waited for it to go significantly further against me. So for this specific outcome, I know it's very nuanced. This is not like a grid approach where you're just every 30 pips add 1 lot. Like it's not like that. It's like enter where you think it's going to bounce, let it go against you, wait to add until you think it's gotten to the next area where you think it's likely to bounce, and then add there. And then if it goes against you again, just wait for it to get to the next area you think it'll bounce. It makes a higher high. It goes to the top of a channel. It touches a resistance zone. Whatever the hell you think you should do, you just wait for it to get to the next area you think it'll bounce, then add there. So with that said, this is kind of a unique situation here, but most of the time what you'll see me doing is I just use the same position sizes to add, and I'll add roughly the same volume at each zone just because that significantly shows the risk. Here's the peak drawdown, 6,600. So yeah, it was like 6K, 6,500. And this is why I think price will bounce, because we're sitting here at a weekly zone. And this was earlier, either today or yesterday, and it went up here. I was waiting for the entry. I was able to start the position. It was today at 7:30 a.m. And now I'm sitting here in this losing trade, having added to it. And then it's already, these ones are starting to go into a little bit of profit, a little teeny bit of profit, a little bit of cute profit, you know, like a bunch of little baby bunny rabbits. And then, you know, you get to be a parent whenever you trade, because you enter your trade, they start off as a little baby. And then, you know, parenting is kind of like hit and miss. Like sometimes your kid turns out great and sometimes your kid turns out like shit. But, you know, I'm not a parent yet. I have a dog, but, you know, trading, it's kind of like if your trade does really well, you know, you get to watch your trades grow up. You're cheering on them. You're going to the soccer game with them, taking them to the first day of school. Then your trade hits the profit target and they end up being, you know, successful kids, quote unquote. Yeah, but then every now and then you have like a trade that just goes into drawdown. It's like you have a kid and they get addicted to methamphetamine whenever they're like 8 years old. And you're like, damn, what did I do wrong? Maybe I shouldn't have lost so much money trading. So then I would have had more money to put my kid in a better school. So I didn't have to go to the public school in the shit area that I live in the inner city. And then they have to go there and they're exposed to gangs and drugs. And I don't want that to happen. Again, I'm trying to help you out here. You got to control risk. Got to make sure you're making money trading. You can send your kid to a good private school. Then they don't get addicted to meth at 8 years old. That's part of the point of this video. You don't want that to happen. So whenever it comes to adding to losing trades, make sure that you're sizing the position small, because if you're not doing that, this is not going to work. Also, make sure that you plan out what you're going to do beforehand. If you enter here, like for example, I entered here. If it would have gone down here, I would have made maybe like a $2,000 profit. Not that big of a deal. Went into some drawdown, I added. Went into more drawdown, I added. And this max drawdown was on this pair was like maybe $6,000. And then plus the extra little drawdown was like a couple $100 came from NZDUSD. But overall, this hasn't really been that much drawdown. If it goes down here and makes a new low, it will. But honestly, I kind of like drawdown. I said it. A lot of people don't want to say it. I kind of like drawdown. Why do I like drawdown? Because I make more on trades when they go into drawdown. If I get into a trade and they instantly run to my profit target, which again, that happens like half the time if you take like a large enough data set. If it just goes instantly to the profit target, I'll make a couple $1,000, maybe 1,000, maybe 2,000. That's cool, I guess. It just doesn't really excite me. When it goes against me in a drawdown, that's where I take off my glasses and I like start running to the computer and I put down my book about reading the Homer's Iliad and the Odyssey, and I stop reading that and I like run to my charts and I'm like, it's gone against me, and it gets me kind of excited. So then I add to it, but really, some people would think, that's good enough. If it bounces there, then I'm going to make a profit. And this is going to be perfectly fine. Me, not me. I sit here, I'm like, again, and I want it to go against me even more. And then I'll add there the third time. And then some people will really be like, they're getting kind of uncomfortable. They see me in here. I'm like saying I'm like, again. And they're like, and I'm holding the gun and they're looking at me from like the crack in the doorway. And they're like, something's really wrong with Nick. We really need to have a conversation with him. This is the third time today he's been doing this. And then if it goes against me again, then I'll add a fourth time. But again, all this is planned out. Everything, the whole risk structure is planned out. It's like, if I start the position here, it goes against me to here, here's how much drawdown it will be in. And here's the position sizing I'll use. If it goes against me from here to here, with those two positions being in drawdown, here's what the total drawdown will be at that third stop where I'll add. Like at the third stop, I shouldn't use stop because you'll think I'm using stop loss. At the third location, I will add the third DCA trade. And if you pre-calculate it, at sometimes your drawdown can exceed any amount of profit you could ever hope to make on the trade. But again, that's okay, because that's going to happen every now and then. As long as you're using small enough sizing, you usually won't blow the account. Prices will usually revert, and then you can get out a lot of these trades and break even if they were really bad F-ups. You can still get out of them and break even. And then most of the time, you can really come out with a profit. Again, you've seen this here. I've showed you everything here on the chart here. I'm going to come out in maybe like a $4,000, $5,000, $6,000 profit, maybe less, maybe more. I'd like to lean in the direction of, maybe more, but it'll be at least like a $5,000 profit if it comes back to that zone. And then I just close there. And then guess what I'm going to do? I'm going to buy at that zone. Then if it bounces, which half the time it will, then I'll make a profit instantly and I'll be sad about making $2,000. I'll have to go to the shooting range and I only can buy $2,000 worth of ammunition to shoot. What is this? A 45 auto? It's a Glock 41 Gen 4 45 auto. I can only buy $2,000 of ammo at the range instead of $5,000 of ammo at the range because I wasn't able to DCA into the trade. If you want to buy $5,000 of ammo at the range when you're going there for full auto Fridays with the boys, you got to be able to make these trades go into drawdown first. You have to be praying for drawdown. You have to enter and you have to bow before your laptop with the TradingView charts open, praying to the Forex gods that there will be drawdown. Otherwise, you just won't make as much money. And then your spouse may go and get a boyfriend or a girlfriend, and then their boyfriend or girlfriend is going to make you sleep on the couch in the living room. Again, this is just a horrible situation to be in. So I hope this video was useful. What I really want you to do, this is the whole point of the video, is I want you to go and test this on your own. That's it. If you liked this video, I'm not even going to ask you to hit the like button or comment, but you can if you want. What I really just want you to do is go test this for yourself. Whenever I realized this, it changed my whole trading career in a very drastic way. And again, this is coming from someone who's been trading for over 8 years. I've seen it all. I've done all the strategies. I've tried to put all stuff together. You know, scalping, the moving average. When they cross, you sell, and it's a 1 to 3 risk reward. I've tried all sorts of stuff. This is so dirt simple that as long as you tune the risk settings right, and as long as you're structuring everything appropriately and putting a small starting balance relative to your total trading capital, as long as you're going through all those motions and doing it right, it just works so well and so consistently. And that is why I believe that oftentimes the best thing that you can do is adding to a losing trade. I'll see you in the next video, my friend. Cheers.